Exchange-traded funds have quickly become one of the most utilized investment classes for both retail and institutional investors because they offer diversification, lower fees than traditional fund-style investments such as mutual funds, and more selection towards specific industries or markets of interest. But hey, if you've been following my channel for a while, you're probably well aware of all this because I've already spoken about ETFs quite a bit on the channel, and in today's video, we're going to be re-exploring the topic and covering a couple new ETFs that are on my radar. Hey, what's going on, savers and investors? I hope you're all having a great day. As always, if you're new to the channel, then welcome. My name's Griffin, and in today's video, we're speaking ETFs. It's been a while since I've made a video speaking about exchange-traded funds, and we're in need of an update and refresher in today's video. Now, we're going to start off the video by speaking about some of my all-time favorite ETFs that really haven't changed all that much. So if you're new to investing, these are going to be ETFs that you're going to want to consider adding to your portfolio first because they're what I call core ETFs that are going to create a foundational layer for your portfolio. And then following that, we're going to be diving into 4 different ETFs that I've identified for various different reasons, and you might want to add to your watch list. I really hope you enjoyed today's video. If you do, please take a quick second to smash the like button for the YouTube algorithm. And if you haven't yet opened your own brokerage account, what are you waiting for? Use one of the links down below to open your very own trading account and get some free money for doing so. Also, make sure to pick up a copy of the ultimate personal finance spreadsheet that you can find down below in the pinned comment. And this is a spreadsheet that's going to allow you to accurately track all your personal finances as well as your stock market portfolio with accurate book cost. So on that note, let's get right into my all-time favorite ETFs first, which are going to be core ETFs to add to your portfolio first for a foundational layer of solid diversified exposure. The reason why I stress the importance of first going ahead and adding some of those core ETFs to your portfolio is because these are exchange-traded funds that track broad market indexes of some of the best markets in the world, such as the Canadian and American stock market, for a very low fee. So this is a great way to build a foundational layer for steady appreciation over time before going ahead and hand selecting some specific stocks and ETFs that might be of interest to you. These are funds that track arguably the best companies in the world and charge a very low management fee for doing so. So I kind of consider these ETFs as being the GOATs of ETFs that all investors should have in their portfolio. This is a strategy that I personally utilize and would recommend most retail investors utilize also because it's proven to provide more consistent and steady returns for your portfolio. So with that said, one of my first all-time favorites happens to be an ETF that tracks an S&P 500 index. In Canada, for example, my favorite is VFV, offered by Vanguard at a management fee of 0.08%. So super low management fee, and in the US market, options would include SPY and VOO at even lower management fees. If we take a look at the growth of the S&P 500 index, this clearly demonstrates my point where this is the type of index that's going to replicate somewhat the growth of the American stock market, and on average is going to return investors somewhere between 7 to 9% annually, which is great for a core ETF in your portfolio. My second all-time favorite ETF is going to have to be a NASDAQ 100 ETF that tracks the top 100 stocks on the NASDAQ stock exchange, and this happens to be companies that are more heavily weighted towards the tech industry such as Amazon, Apple, Google, etc. And for this reason, the NASDAQ 100 tends to return a higher annualized return than the S&P 500. My favorite ETF option for the NASDAQ 100 on the Canadian side is the ETF HXQ offered by Horizons Investments that has a management fee of 0.28%. However, over the past 3 years, this is an ETF that's produced an annualized return of on average 24%. A great American option includes Investco's QQQ ETF, which is basically the exact same thing as HXQ, however on the American side, and offers a management fee of 0.20%. Now, in previous ETF videos, I've also spoken about some fantastic ETFs that I wouldn't necessarily consider as core ETFs. However, these are still going to be ETFs that I think you should keep on your radar. For example, on the Canadian side, the XIT ETF offered by iShares, which is going to track the Canadian information technology sector, as well as the VGT ETF on the American side, which is once again going to track the technology industry, however in the United States. And these are 2 ETFs that have provided fantastic returns for investors over the past 5 to 10 years with no true end in sight due to the fact that the technology industry is continuously expanding at an exponential rate and continues to gain investor interest. In fact, if we take a look at the charts for both of these ETFs, we spoke about them a couple months back when the price points were roughly 20 to 30% lower. However, even though their prices are quite high right now, now, I still think that they have potential for future long-term growth as this industry continues to expand, which it absolutely will. To summarize the core ETFs, we first have an S&P 500 ETF, followed by a NASDAQ 100 ETF, and then following that, depending on how exposed you'd like to be to the information technology sector, you might want to consider adding either XIT or VGT to your portfolio. However, the two first are really going to be your core ETFs to add to your portfolio for a foundational layer of appreciation over time, and then following that, you can go ahead and select some individual ETFs and stocks that might be of interest to you, as well as stocks that we've analyzed on this channel. Alright, so with that said, let's now speak about a variety of different ETFs that are on my radar for various different reasons, and today's video will include some American and Canadian ETFs, so I just wanted to mention that. However, the first one is going to be tracking an industry that we rarely speak about on the channel, but I do think has tremendous potential for growth over the next 5, 10, 15 years as the population continues aging and requires more medical assistance. So you may have guessed it, we're speaking about the healthcare industry, and the ETF in question is the iShares Global Healthcare ETF offered by BlackRock under the ticker symbol IXJ on the New York Stock Exchange ARCA. At the time of filming this video, the price per share of IXJ is $70.33, up basically back to pre-crash price points in a true V-shaped pattern from those March lows. So obviously it would have been somewhat more beneficial to get in on this ETF a couple weeks or a couple months back in order to benefit from some short-term gains. However, due to the nature of the companies held within this fund, which are true leaders in the healthcare industry, I really have no doubt that over the coming years, this is a fund that's going to see tremendous appreciation as there's an increase in demand for medical products.
When taking a look at the fund's fact sheet on BlackRock's website, it says that the fund's investment objective is to track the investment results of an index composed of global equities in the healthcare sector. So not only will this ETF invest in American companies, but also leading companies around the world in pharmaceuticals. This ETF has $2.2 billion in net assets distributed across 108 holdings and has been around for 20 years now, so we have a nice track record and history to base ourselves on, which I always like when investing in an ETF. In terms of the portfolio's characteristics, we're actually seeing a relatively high price to earnings ratio of 25.01 and a high price to book ratio of 4.13, most likely attributed to a bullish outlook for the pharma and biotech industries. So this is actually something that doesn't really surprise me right now, especially considering the current market conditions and the price to earnings of other industries such as the technology industry with a PE in the mid-30s right now. But nonetheless, this higher than average PE should still be taken into consideration and mentioned here. The 12 months trailing yield for this fund is 1.39% net of the management fees, which are somewhat high at 0.46%, but due to the distribution yield and consistent growth of this fund as a result of its diversified exposure, I personally would not be too concerned with the expense ratio. Now, taking a look at the top 10 holdings of this fund, we have Johnson & Johnson at 6.53% for a total market value of $143 million, followed by the United Health Group at 4.98%, and then a bunch of other pharma and biomed companies that we all recognize such as Merck, Pfizer, AbbVie, Abbott, and many more. So from an exposure breakdown standpoint, we're looking at 63.20% in the pharma, biotech, and life sciences industry, and then 36.27% in the healthcare equipment and services industry, with holdings in a variety of different countries, mostly the United States and Switzerland. Finally, for the fact sheet, let's take a look at the performance of this ETF, starting with the average returns since inception in 2001, which is 6.70%. However, over the past 10 years, the average annual return is just under 11%, which is absolutely phenomenal. Cumulative returns over the past 3 years are 24.70%, and over the past 10 years, 182.47%.
So all in all, when looking at the fact sheet for this ETF, it's definitely of interest to me from a holdings and return standpoint that I think could do extremely well in the foreseeable future as the population continues to increase and age over time, and just more people are relying on medical products. Another point to mention here is that what we're currently living through right now from a medical standpoint on the global scale is unfortunately probably not over, and in the future, we're likely to see this type of incident happen again, even though that's really something that is unfavorable. Most likely this will happen in our lifetime, and biotech companies companies are really going to be key in order to provide medical assistance and remedies for this type of situation. If you're interested in gaining some exposure to biotech and pharma companies, then make sure to add IXJ to your watch list. The second ETF that we're going to be speaking about is one that I've actually mentioned in a somewhat recent video. However, my thoughts on it really haven't changed. In fact, they've somewhat solidified since releasing my video comparing the top 5 bank stocks in Canada that was really well appreciated by the audience. So I thought that this ETF was really fitting for today's video because it groups together all of Canada's largest banks as well as financial companies into one single holding. The ETF I'm speaking about is the iShares S&P TSX Capped Financials Index ETF, ticker symbol XFN, on the Toronto Stock Exchange. This ETF is currently trading for right around $32.84 per share, which is still significantly below February price points, as investor outlook is somewhat pessimistic for the whole banking industry due to the fact that interest rates are currently at rock bottom levels, which is definitely going to have an impact on how banks generate revenue. Now, it's really important that you properly understand how a bank generates revenues and how a fluctuating interest rate market has an impact. So if you're serious about wanting to invest in this ETF or individual bank stocks, then I highly recommend that you check out the video that I'm overlaying right here, where we dive into the interest rate environment and how this has an impact on Canadian bank stocks, going through the top 5 Canadian banks in Canada and essentially showcasing which ones are more exposed right now and at risk of having truncated revenues from a low interest rate environment. With that being said, even though banks are most likely going to be seeing somewhat patchy revenue figures in the upcoming quarters, these are still solid companies to add to a dividend portfolio, and at the current price points that you can get in on these stocks and this XFN ETF, I absolutely think that this is an opportunity to get in right now on some future appreciation as well as some great dividend income. All this to say that XFN is an ETF to add to your watch list if you're interested in getting some diversified exposure to the banking and financials industry in Canada, as well as some great dividend income.
When taking a look at the initial fact sheet of this ETF, the investment objective is to seek long-term capital growth by replicating the performance of the S&P TSX Capped Financials Index, and the net assets under management are $1.181 billion, so this is a relatively large fund compared to the others in this video. The fund was created in 2001 and is constructed from 25 individual holdings. From a dividend standpoint, we're looking at a monthly distribution and a 12 months trailing yield of 3.69%. The ratios on this fund are currently really low due to the whole banking and financial industry still being at a discount, so a price to earnings ratio of 9.12 and a price to book ratio of 1.26, which is really low. The fees for this fund are once again slightly higher than a broad market ETF at 0.61% management expense ratio, but regardless, I don't see this as a huge issue considering the fund's returns and diversified exposure. Let's now move on to the holdings of the fund, and as we can see here, it is dominated by the big Canadian banks, starting with the Royal Bank of Canada at 20.84% of the total weight of the fund, representing around $174.520 million. The second largest position is TD Bank at 17.37% and then Scotiabank at 10.98%. By holding this ETF, you'll be exposed to all the large Canadian banks and a handful of other financial and insurance companies such as Manulife, Brookfield, Intact, and Power Corp. In fact, bank stocks represent 67.29% of the fund, while insurance represents 18.90% and financials only 13.58% of this ETF. Finally, let's take a look at the performance of the fund. So since inception, this ETF has provided investors with an average annual return of 8.14%, so right in the ballpark for average market returns. However, due to the current industry conditions, we're seeing much lower returns over the shorter time spans. Now, I believe that regardless of what happens in the short to medium term, most of the companies held in this ETF will perform quite well, especially considering their current price point, and will be offering a nice dividend income for a dividend portfolio. On a cumulative basis, we're seeing the same sort of pattern where over the past 5 years, quite a bit lower return at 23.97%, but over the past 10 years, 100 113.34%, which is quite nice. So again, once interest rates eventually go back up and there's more investor confidence towards this industry, I think investors should expect a nice appreciation from the current price point, and in the meantime, some solid dividend income.
I personally own a handful of these individual bank stocks, including TD, Scotiabank, and Royal Bank of Canada. However, if you're more interested in some diversified exposure as well as passivity, then this ETF is definitely right for you. Moving on now to the third ETF. This is a fund that groups a handful of companies that I individually own, as well as companies that I've analyzed on the channel before, including companies such as Canada Utilities, Fortis Inc., Algonquin Power, and Brookfield Renewables. The ETF I'm speaking about is the iShares S&P TSX Capped Utilities Index ETF, ticker symbol XUT on the Toronto Stock Exchange, and this ETF is currently trading for right around $26.30 per share at the time of filming today's video, which is still down roughly 15% since those March price points, as most utility companies in Canada at least are still recovering from what happened a couple months back. What I like about this ETF is that it offers exposure to a variety of different types of utility companies within the global utility sector. For example, the renewable electricity sector is something that we've analyzed on the channel, and I really think is going to have a major impact in the coming years as more consumers and governments are looking to consume cleaner energy. This provides great potential for future appreciation as well as some nice dividend income, which the utilities industry is somewhat known for.
Based on this fund's fact sheet, the investment objective is defined as seeking long-term capital growth by replicating the performance of the S&P TSX Capped Utilities Index net of expenses, and as we can see from the growth of $10,000 invested in this fund over the past 5 years, this would have returned a nice 59.22% to an investor. The fund was established in 2011 and has $124.38 million in net assets within the fund, spread out through 16 different holdings that we'll be looking at shortly, and the distribution frequency is on a monthly basis, which currently is at 3.53% 12 months trailing yield, which is a nice and healthy yield for any portfolio. As with most utility stocks, the price to earnings ratio is much lower at 17.16x, and the price to book ratio is sitting at 1.74x. So at the current price point, you'd be getting in on relatively cheap assets. Now, this fund's management expense ratio is also a bit higher at 0.62%, and the risk indicator is medium, which I think is fair considering the stocks that are held within it. Alright, so let's now take a look at the holdings within this fund, and remember that there are only 16. So the largest position is 21.84%, which is Fortis Incorporated, and I actually hold a fair share of Fortis Incorporated as an individual stock. This is followed by Brookfield Infrastructure's Partners at 14.67%, and then Emera Incorporated at 11.82%. In terms of renewable energy stocks, this fund holds AQN, BEP.UN, NPI, INE, and RNW, so great exposure to the renewable sector, which again I believe will be fantastic for long-term growth as that industry gains more recognition and demand. In fact, when looking at the exposure breakdown by sector, 13.76% of this fund is comprised of renewable electricity, behind electric utilities at 40.70% and multi-utilities at 29.46%. And finally, what type of returns are we looking at with this fund? Well, since inception in 2011, the fund has returned an average annual return of 6.83%, and over the past 5 years, a staggering 9.75%. From a cumulative standpoint now, well, over the past 5 years, we've experienced a 59.25% return, which is quite nice.
To summarize this ETF, the Canadian utilities sector is known to provide investors with somewhat steady returns as well as great dividend income, and this ETF in question groups a variety of different companies that I've personally invested in on an individual level, so I absolutely think that this is a great ETF to add to your portfolio or your watch list if you're interested in a passive way of investing in the broader utilities sector, especially since the price point for this ETF is still down roughly 15% from February price points, as most of these utility companies are still recovering. And finally, for the fourth ETF that we're going to be covering, this one I guess we could say is more of a bonus ETF because it isn't like the others that we covered in today's video that group together individual companies. Rather, this is a commodity ETF that holds gold bullion in order to expose investors to the fluctuations of the price of gold instead of diversifying your investment across multiple different companies. Now, here's the thing. I've never actually really spoken about gold or gold ETFs on the channel before because I'm more of an investor investor who's interested in dividend stocks as well as growth stocks and rental properties, which happen to be more of my area of expertise and interest. With that said, I've had quite a few viewers on the channel request that I speak about gold, and so for this reason I thought today's video would be an opportune time to do so, because investing in a gold ETF is quite a bit more simple than investing in gold coins or gold bars, even though that would be quite a bit cooler. I think we can all agree on that. I'd also like to mention though that gold typically follows somewhat of an inverse pattern of the equity markets, because when there's fear of inflation or the dollar losing value, investors rush out to buy up gold with the idea that this is going to be a better store of wealth than keeping either dollars or investing in the markets. In fact, if we take a look at the chart of gold for as long as we can see here, which is in the 1970s, we can see this pattern quite evidently, where in the 1980s as well as the 2008 period and right now we're seeing the price of gold spike as the equity market took somewhat of a beating and had some difficulties. So in theory, even though I'm speaking about a gold ETF right now in today's video, do keep in mind that gold price points are at all-time highs right now, and so for this reason it might not be the best time to get into investing in gold. However, if you're still interested in diversifying your investment portfolio into commodities such as gold, this ETF could be a great option for you for a long-term buy and hold. So let's get right into it.
The ETF is also once again an iShares ETF under the name iShares Gold Bullion ETF, ticker symbol CGL.C, and this fund seeks to replicate the performance of the price of gold bullion less fees and expenses. So basically there's just a bunch of gold in a trust, and the price of the ETF is fluctuating in value based on the market price of gold. Since inception in 2011, the fund has produced an average annual return of 5.57% as the price of gold has fluctuated, with the 1-year returns sitting at 30% since the price has shot up from the equity market taking a beating. Once again, this might not be the best time to be buying gold bullion as the prices are basically at all-time highs, but you should definitely add it to your watch list if you're interested in investing in gold, so that you can monitor the price and get in at an opportune time for a long-term buy and hold. The net assets in this case, meaning the value of the gold that's in the fund, is 332.482 million, and that represents 4.17 tons of gold in the trust, with one holding being the gold itself. In terms of distribution, there aren't any because gold isn't going to be paying out a dividend, and the management expense ratio is 0.56%. Note that BlackRock has placed this ETF at a medium to high risk level, which is fair considering the fact that gold is quite unpredictable and volatile in nature, as it's a commodity that isn't necessarily a productive asset.
As mentioned, I currently do not hold any gold or gold ETFs. However, this is definitely of interest to me, and I might be investing in it in the future as the price points become a bit more favorable. So it's definitely something I'm going to be keeping my eye on and learning more about, so that I can share more information about this commodity in the future. Alright, so I really hope you enjoyed today's video, and I'd love to know your thoughts down in the comments on these different ETFs that we covered at the beginning of the video as well as through the middle and end of the video. Let me know down in the comments what your thoughts are. Are any of these ETFs currently on your watch list or even in your portfolio, and which ETFs are also on your current watch list for the near future? I'd love to know once again down in the comments. So if you enjoyed this video, make sure to smash the like button. It really helps my channel grow with the YouTube algorithm, and consider subscribing to the channel for future content related to stock market investing, personal finance, and real estate. So if you want to learn more about these topics, make sure to check out one of the 2 videos that I'm overlaying right here. And on that note, I hope you have a great day. I'll see you in the next one.